This graph compares $100,000 in cash against an S&P 500 ETF over 20 years. By year 20, the gap is massive. Cash shields you from daily market dips, but as inflation compounds, it loses nearly 50% of its purchasing power. Knowing the math is one thing, but acting on it is another. Many of us are held back by inherited behaviors, an anxiety that makes us hoard cash, or a lifestyle creep that eats up our surplus before we can invest it. Once you decide to actually put your money to work, the problem shifts. The challenge isn't deciding to invest, it's choosing exactly where to house those assets and figuring out how you'll eventually pull them back out. Pick the wrong account structure or the wrong withdrawal method, and you expose yourself to severe tax penalties, cross-border reporting nightmares, or running out of money years before you expected. Every choice you make from here is a trade-off between securing immediate tax relief today and preserving flexibility in how you withdraw your money tomorrow. Securing your wealth depends on a specific order of operations for your assets, a sequence that offsets the drag of the tax code and replaces emotional decision-making with mathematical rules. Before any capital gets invested, you have to build the foundation. That means capping your non-mortgage debt-to-income ratio and automating your savings transfers so the money leaves your checking account before you have a chance to spend it. If you have existing debt, you have to choose a repayment strategy. This quadrant chart maps out the two main approaches, weighing mathematical efficiency on the vertical axis against psychological momentum on the horizontal axis. Up here in the high math, low psychology corner is the avalanche method. You pay off your highest interest rate debts first. It saves you the most money and clears the debt fastest, but because those balances are often large, you go months or years without the psychological win of crossing an account off your list. Down in the high psychology, low math quadrant is the snowball method. By attacking your smallest balances first, you get immediate wins. That psychological momentum keeps you motivated, even though it costs you more in total interest over the life of the loans. The right choice depends entirely on your own behavior. If you can stick to a strict spreadsheet, use the avalanche. If you tend to lose motivation and abandon your budget, the snowball is your best bet. Once you're ready to accumulate wealth, you face a battle between account architectures. This matrix compares tax-free accounts, like the Roth IRA in the US, the UK ISA, and the Canadian TFSA, against tax-deferred accounts, like a traditional IRA, a UK SIPP, or a Canadian RRSP. As the tax-free column fills in, you can see how they work. You fund these with post-tax money, meaning you get no deduction today. But in exchange, every dollar of capital growth, every dividend, and every future withdrawal is permanently immune from taxes. Now look at the tax-deferred column. These accounts give you a massive upfront tax break. In the UK, a SIPP can provide an immediate 40% boost for a high earner. The trade-off is that your capital is legally locked up until your late 50s, and everything you withdraw later is taxed as ordinary income. There are also rare hybrid models, like Canada's First Home Savings Account. It blends the upfront deduction of a tax-deferred account with the tax-free growth of a tax-free account, provided the funds are used to buy a qualifying first home. Regardless of which architectural wrapper you choose, filling it with self-directed ETFs generally guarantees lower fees and better tax efficiency compared to traditional managed mutual funds. Your goal is to compare your current tax bracket against your projected retirement bracket and select the structure that results in the lowest lifetime tax burden. If you ever plan to move abroad, a perfectly optimized domestic strategy can instantly turn into a massive liability. Look at this cross-border scorecard. If a U.S. citizen moves to the UK, specific tax treaties protect their capital. As long as filing rules are followed, that green checkmark means their Roth IRA remains fully shielded from UK taxes. But if that same U.S. citizen moves to Canada and opens a tax-free savings account, a red X appears. The IRS does not recognize the TFSA's tax-free status. They will tax the internal gains anyway and force the investor into brutal, expensive international reporting paperwork. Even if you stay put, local laws change. For example, starting in April 2027, new UK legislation will strip away protections on inherited pensions, suddenly subjecting them to a 40% inheritance tax. As your net worth scales, Ignoring geopolitical borders and impending estate legislation is a direct path to destroying your wealth. Eventually, you reach the final phase of wealth, the drawdown. For decades, retirees have relied on the 4% rule, but testing it against modern early retirement timelines exposes severe systemic risks. This chart simulates a 40-year early retirement. If you rigidly withdraw 4% of your initial portfolio, adjusted only for inflation, a bear market early in your retirement introduces a massive sequence of returns risk. Watch the static line. It plummets straight to zero, completely depleting the portfolio. Recent data from Morningstar shows that even for a standard 30-year timeline, a mathematically safe static withdrawal rate is actually 3.9%. That small drop means you have to save significantly more capital up front just to generate the same income. There is a mathematically superior alternative, Vanguard's dynamic spending strategy, which relies on strict spending caps and floors. When we add the dynamic strategy to the chart, the difference is clear. This framework allows you to start with a higher initial withdrawal rate of 5%. But the strict rule is that during a market crash, you must slash your spending by up to 2.5%. By adapting its slope during market dips, the dynamic line successfully preserves the portfolio indefinitely. A mathematically safe retirement cannot be built on rigid rules. It requires profound lifestyle flexibility so you can absorb the shocks of economic recessions. To apply these frameworks, you have to map them to your specific life stage. This decision tree is the Inside Anchor blueprint. It starts here at your base income, establishing the automation and debt strategies we covered earlier. If you are an accumulator, early or mid-career, the tree branches based on your income bracket. Because your current earnings are relatively low, the blueprint points you directly toward tax-free accounts like the Roth IRA, the UK ISA, or the Canadian TFSA. You want to capture the permanent tax-free status of these vehicles right now, while your marginal income tax rate is still cheap. But if your income scales up and you become a high-earning optimizer, the math flips. The tree highlights the high bracket branch, pointing you toward tax-deferred accounts like a SIPP or an RRSP, so you can immediately capture the massive upfront tax relief. Cautionary tone. If your career takes you overseas, you hit this warning node. You have to aggressively harvest that upfront tax relief while vigilantly dodging all the cross-border traps we mapped out. Finally, as you move into the near-retiree phase, the blueprint reaches the retirement horizon node. Here, you must abandon the rigid 4% rule in favor of a dynamic drawdown strategy and instantly begin restructuring your assets to mitigate your upcoming estate tax exposures. Effective financial optimization happens when you abandon generic rules and strictly match your account choices and withdrawal rates to your personal income and tax reality.